we talked about the disconnect between the masses and the wealthy last week. And today I want to dig down a little deeper because one of the issues came up with some of the frustrations about people, and it got into the rich versus the poor. And I want to dig into this a little bit more today. So we've had a big move in household net worth in the US. It's over $150 trillion. It's moved up quite a bit, as you can see from the chart. So 150 trillion of net worth has grown in the US. Pretty incredible. We've moved up from 100, where we were running between 100 and 120 trillion dollars of net worth for most of the last 10 years. What happened all of a sudden since the pandemic, we've seen a pretty good spike up. And I think part of this is really the reason that quantitative easing was put in place to begin with. Can you see the screen now, Mark?
Yeah.
Okay. Was to stimulate asset values to offset the debt. So we've done that pretty well. You've seen the asset side of the equations grow nicely, but the benefits have been shared fairly unevenly. And we'll show you how it plays out. So here you see the share of net worth held by the top 1%, owning about 30.5% of the net worth. The 50th to 90th percentile, so we missed the 9 of the top 10%, owns another 31% of the net worth. And
that's interesting. So what we're seeing is basically the 1% or whatever, they really took it from that next group.
They took it from some, but there are people who, it's actually interesting. These guys got hurt a bit. And ironically, the bottom 50% went up, but they didn't go up quite as much overall. But what's interesting is the stimulus payments made by the government in the US really did help the bottom part in terms of the net worth. The other thing they did was they made some adjustments to their asset base coming out of the financial crisis. But looking overall, it's really no surprise that the rich hold more stock and less debt. We're going to go into this a little bit more. What this chart shows you in the blue is on the far left is pension accounts for the bottom 90%. This is the next 9%, and the top 1% is in the red. And as you can see, their pensions, the wealthy 1% aren't big on the pension net worth, bigger on real estate, but still real estate a big part for most people. But what you are seeing is the stocks and mutual fund differentials being quite high, and the total debt issues being on the other side, the reverse. So not a surprise, it's the way we live, but we'll get into this a little bit more. But I want to get into the composite numbers and what they're missing, because they don't reflect the big dispersions that are going on. So we've had a big change in household balance sheets over the last 7 decades. A lot of reasons for that. We've had a lot of crises. We've had a couple wars, but we had massive tech advances that were driving it. We had globalization, all the things we've known that have occurred. And then more recently, we've had the pandemics. But over the last bit of time, over those 7 decades, you saw assets grow quite a bit from an asset to income ratio that went from 2 to 5. But the liability to income ratio went up a lot less, from 0.5% to 1.5%. So you had this really interesting change in the last couple of years where the liability ratio declined from 2010 to 2019. And I think that's a reflection of the fallout of the great financial crisis. And people felt that debt was really a big problem. They got it under control, and they moved back to really putting the focus on strengthening their balance sheets. And that worked. And you can see that that's worked. But it also led to a better increase in a different increase in the assets in the liability ratio for young people, where it improved a bit for them. But when you look at the big numbers, it's masking the problem. So when I raised this issue last week and said, yeah, net worth's up a lot, but why aren't people feeling it? We'll get into this. This is the aggregate, and the aggregate is really misleading. What this shows you is the assets are in the light blue. In the pink is the asset ratio is the light blue. The liability ratio is in the pink. and the red is net worth. And what you can see is on the left, the 60s, and you saw it pretty constant with assets and liabilities ratios running very tight. You moved to the 80s and the asset boom started to take off when we started to see the big moves up in the markets in the late 80s and into the 90s. But debt really didn't take off until the great financial crisis into the tech bubble when it burst, when we took rates down to zero the first time. And you started to see debts starting to rise, and then come forward to this period where it started to peak in the level of debt. And then you started to see it ease off, while assets have come down some, but not as much. So the ratio overall looks very healthy. Assets have grown quite a bit, but the liabilities did not grow quite as much. And the ratios held tight, and that put us in a much better financial spot. Unfortunately, it wasn't borne out evenly. And this chart shows you a comparison of what under 45-year-olds looked like and what over 45-year-olds looked like in their assets to income and liabilities in the 50s and 2010, and then what the old looked like. And you can see the young people's assets moved up, but they didn't move up. They moved up only a fraction of what the older people's did. So you saw that the move up in their liabilities to assets was more pronounced for the young people, and that's typical and understandable, but it set us up for a big problem that we're living with today. So when you can see this chart, and I apologize, it's not the best, it didn't translate best to the slide, but what it shows is how much the liabilities have increased while the assets for under 45-year-olds have not moved up to the same degree. And that's really where the struggles are, and I think the frustrations from the population are coming through is the uneven sharing of the blessings is really what's come through. When I show you the over 45-year-olds, again, very tight band here. So going back to the under 45, tight band in this stage, and broadened out more so on the liabilities, a little bit on the assets. Go to the older people, tight band in the 60s to 70s period, and then the 80s it really starts to take off. But the liabilities grew, but not quite as much as the asset growth. And then they started pulling in their liabilities as we moved through the last several years. So big divergences there between the two. And I think this is where the frustrations come, because the broader segments are not feeling the benefits of it. And when you go back to the original charts, so much is accrued to the top 10%. And so many people in the middle class have felt like they've been marginalized. So I think there's some changes that are going on that are still going to be very positive. If you go back to 2008, when that crisis occurred, there were a lot of people who felt they were never over 65, were never going to own equities again because they couldn't take a 40% drawdown like they had back then. Or younger people were never going to own equities because they saw how rigged the system was and all that. What's interesting today, as you're seeing from this chart, the younger people have changed their views and are shifting more towards equity ownership. Their household ownership has not gone up quite as much, but their equities are starting to rise again. And I think there are a couple factors in there. I think the gamification of the stock market with the meme stocks actually increased the interest. I think it also increased their awareness and knowledge base about stocks. And I think then they got smarter about investing after the meme stock run. I think on the other hand, they've been more leery and less able to own homes. And that's changed where they're putting their assets and how they're thinking about their mix. I would point out one other change that's going on in recent times, and I think this is just starting to see more articles about this, is that the pension assets, the defined benefits, are starting to be talked about by companies again. And I think when we talk about the fallout of some of the diversity, equity, and inclusion policies, I think one of them may be a return to more of a defined benefit type investment retirement structure in the US. I think you'll see some companies picking that up, which could benefit a lot of the workers as well. So I think some of the shifts that have gone on from the great financial crisis to the pandemic are actually starting to show through in where asset allocations are going, in people's attitudes towards different asset classes. And obviously business ownership always picks up in times of crisis. And I think you're going to see a barbelling where young people and some of the more newer immigrants coming in are going to really be focused on starting businesses, because it's maybe a little bit easier to start businesses today with technology. And that's going to change business ownership. And as we know, business ownership leads to some of the greatest wealth. So I think it's a very mixed picture. There's a lot of conflicting numbers, and I think you really want to go below the aggregate to really understand what's going on. And even there, you have to keep going down and down and down and peeling back the onions to understanding how complicated the US economy is, and therefore the global economy is in this environment. I want to just jump to the big themes again, and we'll wrap up. Inflation's down, but I think one of the problems politicians are having today is cost of living is rising, and the communication of inflation numbers and bragging about inflation numbers when people are feeling it, the cost of living every day when they go to the supermarket or go to buy a car or buy a home. Those are the issues that people are really recognizing. And I think that's part of the disconnect between the elites who are focused on inflation coming down, because they didn't feel the inflation effects the same way as the poor do. And I think that cost of living is what we're stuck with. And I think that's a big issue. I think the other big theme that we're dealing with our elections and with what's coming up around the world is the domestic and global fragmentation that's, I think, has some inflationary pressures that are weighing on central bank policy. And I think that the combination of the first two items is slowing down the ability to lower rates because of fear of the inflation fight not being done. I also think the reindustrialization of the global economy is inflationary in the initial stages before you get the benefits, because you're basically setting up dual systems for everything. And the benefit of globalization was to eliminate and move to the lowest cost things. When you're setting up dual systems, you're increasing the cost. But I think the issue, when you were talking about this, and Mark, this is really to me, the big theme for AI is, does it create the productivity boom necessary for companies to offset their cost issues and for the economy to be as efficient as it can be moving forward? So I think that's where you're going to see the benefits of AI come through, is where you can see the productivity to counter either labor or cost issues that allow us to be much more efficient, because that's the promise. Do we get the reality to back the promise? And then lastly, where are we putting money to work? I think you want to focus obviously on technology, but you got to be careful about valuations there. There's a lot of momentum in this space, but not everyone's winning in that area. So I think that you got to be careful about the hype train there. I think industrials is one of the more interesting areas in the US. And I was just looking, we've put out in the CHIPS Act about $1.5 billion to one company for it. I think they'll move another 4 of those $1.5 billion opportunities for the CHIPS Act out this year. And think of that, that's $7 billion going to 5 companies to build industrial complexes, whether it's chips or other things in the US that are going to help us with either the reindustrialization, the climate shift, and national security. So I think there's a lot of money on the come into the industrial base in the US that'll support industrial commodities as well, although they're continuing to be caught up in the China-US trade issues and China's stranglehold on the commodity sector overall. But I think as you start to see the bifurcation of the global economy from the global fragmentation that's going on politically, that sets up the need for the West to have their own secured supplies of rare earth steel and copper, and they're not in high supply in those areas. So that's a big opportunity. We still like the energy space on both sides. The more AI comes in, the more need for powering up the system is going to be. So we continue to like both areas, both fossils and renewables there. Healthcare is one of the best opportunities in our view for AI to really improve costs and outcomes. So we think that's an area you got to be in. We're a little bit leery of the big pharma companies and the pricing and some of the challenges coming their way. But clearly there are a couple of them on the Ozempic bandwagon and Mounjaro that are blowing things up right now. But you just got to be careful about the hype and everything. And really focusing on quality dividend payers is going to be one of the big issues. We think there's a balance between hypergrowth and value that are going to be in tough areas when you're looking at companies with 30% growth, but a 90 multiple on it, everything has to work for you to win in that case. And then some of the best companies have seen their multiples come in with their growth rates holding, and those are creating great opportunities. So it's really a stock market that you really want to be quite discerning in. And I just saw today in Bloomberg that BlackRock was out touting active management this year for one of the biggest passive managers. I thought that was an interesting take. And they think the dynamics are such in the global economy that whether it's the persistently high interest rates or higher for longer interest rates, whether it's the global fragmentation or whether it's some of the other issues that we're seeing, they believe that stock selection is going to be paramount over participating in the market. So a lot going on. I think that what's going on with the consumer is actually quite interesting. I think overall, when you look at the U.S. consumer, the bottom end has come out of the pandemic in better financial shape, but relative to where they were before the pandemic, but probably a little worse off relative to where they were pre-pandemic. I think the rich have gotten richer, and I think the middle class has been bifurcated even some more. And I think that's an area where you'll see some of the real frustrations coming through that'll be reflected in the election in November. So, Mark, I'll stop there and open it up for discussion.
Great. Thank you again. Questions, comments? Everything's clear?
Not enough AI.
Adam?
Yes, good morning, everyone. Stephen, thank you. Can you go back to that chart where you had the different asset allocations of equity and business and other assets?
Yes.
In my question, I have two questions on that. The other assets, maybe you said this, I didn't hear it. What are those other assets? That's my first question. The second question is, how will this chart, particularly with the 18 to 39-year-olds, how will this chart change as the boomer generation transfers 80 trillion over to the younger generations? Those are my two questions. Thank you, Stephen.
I think the chart will change where that'll allow them, the wealth transference will allow them to own homes or maybe own better homes than what they're able to access right now. I think you'll see a continued increase in equities, and I would suspect that the younger people would see more private businesses pick up. I think the other assets would be it's cars. It's there's a whole list of it, Adam. I can get that for you, but it's all the other things. It's cars, it's art, it's other intangibles that they might have, boats, whatever. It would also be other assets, not equities. So some of that would be fixed income as well. That's not captured here.
One last question. The disposable income, how has that changed?
I haven't gotten the breakdown for the younger by this segmenting, but I can tell you that debt to disposable income has actually come down since the financial crisis. And I think that's one of the big issues that came out of the great financial crisis is when young kids saw their families either had their homes foreclosed, saw parents get laid off the way they did, it changed a lot of the attitudes. It changed their attitudes towards equities. If somebody had all their net worth in the family in a stock like Lehman or one of the companies that went bust, and I say Lehman because I had a lot of people in my town that got caught up in that, and you saw their lives change considerably. And I think the younger kids felt that wipeout that went on back then, and I think it changed their attitudes towards equities, which is why I think seeing equities move up after this 10-year period is the sign of a change there. So I think those are some of the big issues. I think what happens when young people get a lot of money would be better to ask some of the next geners on the call.
Well, let's just. Samir's got his hand up.
Okay. Thank you. So, Steve, a question I had about productivity increase.
Yep.
It's clear that AI will lead to huge productivity increases. The question I have is, what does that do for concentration, right, of wealth, right? Is that a factor that would lead to increased concentration of wealth? And what do you see? Would that lead to? So, for instance, if AI starts taking over all legal jobs, right? From the bottom of the pyramid, all paralegal jobs go away, all basic accounting jobs go away, so on and so forth. Does that create potential political issues going forward? Are there sort of regulatory or other, let's say, interventions that may become politically, desirable or asked for in order to address the increasing inequality that may result? What are your thoughts on that?
Absolutely going to have big political implications over time. I'll leave it to the AI experts here to fill in all the different areas, but I think it's definitely will create inequality. It'll create big winners. Every tech advance does. If you look at, just look at the tech companies now and look at the wealth that was created by Apple and Google and Amazon. I mean, they created new technologies and they created new class of wealth. They've also taken it away from other areas too. So I think you'll see those shifts go on. That's normal, and that's just going to happen. I think the issue on this one is how big and how fast it gets, and I think it's still too early to know. But I expect there'll be dramatic changes. But I think we think about that all the time, and they end up kind of taking a lot longer to happen, and they're maybe not as draconian as everyone thinks. But it's too early to tell on this one for me. So I don't know if some of the other AI experts want to weigh in on that, but not sure.
We'll definitely be addressing that in New York in spades. Sorry, CJ, I cut you off, but
no problem, Mark. I just wanted, I may have missed the opportunity, but I wanted to speak to what Stephen said about the great wealth transfer. We co-funded with Bank of America a report in 2022 with Cerulli Brothers, Cerulli research firm, and a couple of the conclusions, one of which is that millennials, specifically Gen Z following them, are leaving the stock market at the greatest pace in history. They're lightening their allocation to fixed income as well, but at a much greater pace in securities. And right now, millennials have the highest average allocation as a generation in alternative investments at 18%. When you consider that Gen X, my generation right before, was 6%, a 3x move intergenerationally is unheard of. And there's also extrapolation and on the research that's showing that Gen Z will pass the magic 20% mark, getting to David Swenson's 30, which really wasn't 30% because it was in a tax-free environment, so it was more like 23%. So the promise of alternative investments is being realized in the generations at the expense of securities and fixed income. One last thing that they found is that intergenerationally, the retention of registered investment of advisors, generally wealth managers and wirehouses or registered investment advisors, was at 13%. They're losing next generation clients 87% of the time. That was one of the biggest numbers. I thought. I was like, wow, no wonder there's consolidation in the RIA space. It's unsustainable.
Where are they going?
Self-directed. And one last number I'll give you to your answer. 63% said friend at a party, general advice, wealth management advice, friend at a party, TikTok, not TikTok, but all social, but TikTok, influencers, finfluencers. And my favorite one, 22%, I don't know.
CJ, I agree with the numbers you said. What I would question is going forward, when rates moved up from 0 to 4.5%, will they still be as attracted to the alternative area?
Great point, Stephen. Great point. Actually, there's a follow-up coda to that same report that was 2022. Obviously, what you just said shows there's a little bit of obsolescence in that report. They're doing a follow-up based on the new interest rate environment. So very interesting. Stay tuned.
Yeah, I think that's going to be one of the keys is, and the other thing is as they get more wealth, I think the interesting thing is how does their views shift from self-directed to do-it-yourselfers to seeking advice. There are big changes that go on in there. They tend not to stay. I think the number is like 70% of young people leave their current advisor to go to a new advisor, their parents' advisor to go to a new advisor. So they don't stay where their parents have been. So that's the other big thing they do. They go somewhere else almost automatically.
Absolutely, I agree. They're still finding out about where that landing place is. I'm putting the deck that was created from all of that research with Cerulli and B of A in the chat. Everyone's welcome. It's a cloud-based link, so don't worry, no one's stealing anything. It's a cloud-based link for everyone to use. It was given as a keynote a few places, Global FinTech Conference. There it is. You can use it as you wish.
And CJ, I'll be in touch on other things.
Okay. It's not. Let's see.
Radek, you're up.
Okay, I'm unmuted. I just wanted to drop a short comment around Samir's question and Steven's answer around AI that will change the wealth distribution and will be a huge market change. So yeah, it will bring a disruption that can be negative, of course. However, on the other hand, this may also be the solution, and I'm sure that Esther will be talking about this in New York, especially that if you dive deeper what is going on in this area, you can see that the models and AIs arise that can be taught of human experience and human knowledge. So then it becomes more empathical or can guide this change or to a better solutions for all of us as a society.